Hello and welcome. This is the Mutiny Investing Podcast. This podcast features long-form conversations on topics relating to investing, markets, risk, volatility, and complex systems.
All right. The first thing that jumped out at me when I was thinking we were getting on a call today is I think a few days ago I got one of your monthly commentaries as well, is how do you come up with all these quotes? Like, where do you have these on deck? Like, you always have all kinds of quotes that go perfectly with what you want to talk about. But I'm like, where is the compendium of these quotes? Do you have some sort of program we don't know about for searching out quotes? What's the deal with the quotes?
Yeah, it's funny. So for starters, I love quotations. And tiny side note, I was once told by a teacher, because I kept on calling them quotes, and they're like, no, they're quotations. So, I don't know if anybody knows that, but apparently they're not called quotes, they're called quotations. Either way, I love them. And so I just, my brain always wants to, whenever there's something to say, I always want to see or find like who said this in a cool way, or I'm thinking some thought. And I have had quote collections in my I call it Google Docs for years, and whenever I see a cool quote or quotation, I put them in there, and I've collected like now in different sections, and i.e. what it's about finance or about life or about etc. So a lot of them I remember when I'm talking about or writing about some topic, I'm like, oh yeah, that triggers that quotation. Let me go grab it. It's in my Google Doc or one of my docs that I've kept things in. And then if there's something that's not triggered, but I really want to put something there, then I'll go online and I go to some of the great quotation sites, like Brainy Quote is one of my favorites. Yeah. And I type in my search word, and then I just scroll through them. And honestly, part of the pleasure is sitting there reading the different quotations of, what obviously certain different famous people have said, and seeing, hey, does this fit, does that fit, or feeling it or not. And what's really cool with that is that as I go through them, I'll read one, that's silly, that's off point, or it's like a silly person that I don't want to put as a representative of my thought. But then when I get to one that shines, there's this like inner moment. I'm like, yes, that's it, and I love it. And then I obviously just put it in the letter, and it works perfectly. And when I find those, it's such a cool moment. Sometimes it's funny because of who said it. I'm like, I don't know, I love what they said, but can I quote that person for whatever silly reason? And it's nothing substantive. It's just like some movie star, and I'm trying to say something deep about finance, and I'm like, well, does that really work? But in the end, I go with the power of what they said, and hopefully it's a person that substantiates what I've said in some way a lot of the time. But yeah, I can't. I'm so quotation loving that I have to find the exact right words for saying what I want to say. It's funny that you noticed that.
Well, so it's half the monthly letter time writing it, and then the other half of the time is finding the perfect quote.
You know what? It's probably yeah, exactly. Right? You got it. Yeah. I'd say it's 70-30. Probably 80-20 if I really think about it. With 20 finding, but the finding the quotation becomes a joy. Like, I'll sit there for hours reading through stuff, and it's like until I find that perfect one. And the joy is obviously searching them. And then of course each time I've done that over years, then I have that call it encyclopedia of quotations in my head, because I've read them for each letter. So then the next point comes up, I'm like, oh yeah, I remember where I saw something that fit, and so it just becomes cumulative, which is nice.
Well, then the part that sucks is when you find the perfect quote after the letter's gone out, and you're like, oh, come on, I wish I could have used that one.
Yeah, you know what? That's a good thought, but I don't let that happen, because I don't look after it's gone out until the next letter comes up. I guess I do once in a while when I'm trying to think about something else, but not generally for the letters. I make it right after the letter's written. I'm like, okay, I need something here, and that's how it goes. Yeah.
Well, you're saying quotation versus quote, and the pragmatism or how we use language these days remind me of my girlfriend has musical theater training and everything, and so she would always tell me the difference between accent and dialect is we actually use that wrong. It's actually we should be saying dialect instead of accent, and then accents when somebody's speaking is a foreign language speaker speaking English. Yes, okay, yeah. That's actually accent, and dialect is the regional differences within a country.
Oh yeah, there you go. That's the nuance. Yeah.
But pragmatically, we all say accent. So even though she used to always talk about it, I was like, come on, everybody's going to say accent, so we use accent. It's like, as language evolves, which may be part of our conversation today, is like, things change. Like the word literally has now become to mean its opposite. And the people that get upset about it don't realize that like language is an evolving, emergent, biological or evolutionary phenomenon that's constantly changing. And it's like, how do we use it colloquially can change the actual definition of the word.
Totally. Yeah. And if you're a word person, then you
Right.
notice and think about that stuff. I'll tell you one of the funny ones of those for me is, and I hear it every time because a lot of people say it. I used to say it. Is saying something is very unique. And because I had this one teacher who I'm like, it's something that's very unique, and they're like, you can't qualify unique, right? If it's unique, it can't be very unique. Unique is one of a kind. So there's no very one of a kind. It's one of a kind or it's not, right? And so you can't ever say anything before unique. And I'm like, I find it funny because everyone always says that. Oh, that's so unique, or very unique rather.
Right.
I'm like, no, it's just unique. But I don't actually say that. But I think it and laugh because it's one of those things like you talk about. It's a very unique thing.
So let's. I was just looking at through some more of your recent tweets, and even on your recent tweets, you started even including the quotations as well. And one of them was trading recent markets. I found benefit in being more nimble. That is, being more ready and willing to wholly flip an assessment. A good long can be a good short, or vice versa. The question is at what moment and for how long. And then the quotation is from Emily Dickinson: "Is forever is composed of nows." And that's what I want to kind of dive into is this forever is composed of nows. I think I sent you last week, I sent you an article from your neighbor, Annika Harris, about time, right? And as more as she's delving into working with physicists and whether it's, thinking about time and space and consciousness, is a lot of the physicists are starting to believe that space and time are just made up by our consciousness. And so with your Emily Dickinson quote, I'll give you that to riff off of it's like, forever is composed of nows. Like, what does that mean to you?
I just love that one. That's one of my favorite quotations of all time. It means so many things. I think, do we have like 4 hours for this session? Because
of course.
I can go on a lot. No, so let's start with some of it. So philosophically, all we have is now, right? I mean, not philosophically, literally. We don't know the future. We certainly can't go back and change anything in the past or reach into our past. And of course, that's the teachings of some of these great wisdoms or philosophies is all we have is here and now. And that's the essence of appreciating our life and the moment and getting joy in the moment. Like now is it. And so, take that to the next step is there's now, and then, by the way, there's now, and then there's now. And so literally forever, and i.e. the future, is just composed of every immediate next moment or current moment. Hence, forever's composed of nows. And then, to me, of course, I'm a quant, I'm a math guy, a mathematician, whatever you want to call that. Love numbers. That is the simple way I think about it, and love looking at things in a quantitative way. Emily Dickinson, of course, is a great poet and writes beautiful things. But when I read that, I think of it mathematically in the sense of like limits, right? I mean, calculus is the idea of like there's the nows that are spliced into times. Like I'll go back to not go back to, but I'll refer to like Zeno's paradox is one of the great concepts in philosophy, where if you shoot an arrow and before it gets from beginning to end, it has to go halfway, and then before it gets from there to the end, it has to go half of that before the end, and then half of that, right? And so you keep on having to go half such that you never get there, right? And so the limit of all those eventual movements where you're at 1/1,000,000th of that next move is of course getting to the finish line, right? And so I think of that in the sense of forever is composed of nows, is this like these separated instances where collectively is your experience, but each one is just a now as a splice in time. I don't know if that analogy makes sense, but in my mind, it's like in calculus, you have to use limits to go from the infinite to the moment, to the finite. Whereas in life, we live time as an experience. Like the article you sent me was that we really there's now and now and now, but it's fluid in our mind as this kind of thing we're like living through, right? And so we accumulate the separated moments into a living stream, and hence it all comes together in forever is composed of nows. Does that all make sense, or how do you feel when I say that? It's a little bit all over the place, but that's how I think about it.
No, it is great, and that's what it's one thing and maybe I'll get it both on Zeno's side and the idea of we have this just collection of nows, but I think that's one of the things that Anako is writing about is the idea if you have a collection of nows and then our consciousness creates it creates time out of that, right? Like it creates a series of events and causality, and then we tell ourselves a narrative story in hindsight. And that's what the collection of nows starts to make sense to us on what we would consider a conscious level. Now we can debate whether we have consciousness or free will, but what's interesting about that to me is like if the thing that we use to collect these nows and to create a sense of self, and then the physicists are telling us it's possible that space and time don't exist and it's just a collection of nows, I'm not sure the thing we use to think about that can conceptually even come up with that concept. Like it really just literally breaks our brains if you try to take time and space out of the equation, because everything we know and understand about life via our consciousness has to use these equivalents of space and time. And so to me, it's almost like the Mysterians or new Mysterian philosophers like Colin McGinn. The question then becomes, can consciousness be used to study consciousness? And they say no, like it's always going to be a mystery, hence Mysterianism, that we will never be able to understand it because the very tool we're using to understanding is a false tool that actually doesn't exist.
Right. Yeah. So once again, I'll go back to math. I'll go back to calculus.
Okay.
Right. In calculus, so the like a derivative is a change of something's position. X goes from here to here, right, with respect to some change in time, right? So that what's happening to us, we experience time, but what's actually happening is the molecules and atoms that make us and everything around us are just changing some incrementally small position over some instance of time, and as each one of those increments change, the calculus of our minds folds that into some smooth stream, right? But all that happened is this one atom went from here to some incremental distance in front of it within one split second, and now like this one hair got slightly grayer, right? In some tiny incremental way, right? And so all of that happening, changing in position, like is there time? No, there's just change in positions with respect to some space-time dimension or dimensionality, and then when that happens, our brain must interpret that in some way, and therefore we create this fluidity, right? So it's obviously our brains that's creating it, but all that's happening really is that things are changing around us. If atoms stop changing, then time would stop. But it's not that time stops; it's that things stop moving. Really, is at the essence of it. That's how I think about it. I don't know if that's what you're addressing, but to me, I guess that summarizes the answer. That all of it is happening in our heads. Nature is doing what it's doing around us, and our heads is creating this flow of time. Therefore, right. It seems silly to think about it as like, oh, is our consciousness looking at our consciousness? No, it's that our brains are interpreting these incremental changes all around us.
But that's what I'm saying. So if our brains are creating this flow of time, can we use that brain to therefore think about what would it be like without time? Or is that a self-delusion mechanism? Is like we can't even use the thing that experiences time is the thing we're trying to say time doesn't exist. And so are we fooling ourselves?
Well, it doesn't exist and it does, right? So to me, the answer to that is a matter of scale. It doesn't exist at those ultra minute increments, right? If we go down to the quantum or some really small increment of time, there is no time, right? Or so to speak. But since our brain creates it, then to us, there is time, but at a larger scale. I have the analogy that I just thought of is a movie, right? So a movie, if you take the old school tape off the reel, it's a photograph and a photograph and a photograph, and then the dude's waving, and it's like, and you play that at a higher speed. It's like, hey, and so you see the arm flow across the room, right? But really, it's just 100 pictures at 60 pictures a second or frames per second that ends up creating a movie. So at the scale of each photograph, there is no time. But at the movie level, there is time because you're running it at 60 frames per second. That's, therefore, to me, there is and there isn't. And it's not contradictory. It's a matter of scale.
Everything good in life's a paradox, right? It's not necessarily contradictory, but it makes you think about it. Like, I don't know, my family actually owns a movie theater, and this was even, I worked there digital projectors, and so I actually had to use to splice those reels together. So it always does make me think about it a lot of like, yeah, looking at those at frame by frame, and then the interrupted action between frames, and how our brain can actually blend that together without us even noticing it.
Totally, and what's interesting, yeah, if you ran it, I think they've tested this. Of course, they have to have at different rates. Like if you ran a movie at, let's say, 10 frames per second, we'd say, oh, that feels slow. Or ran it at 200 frames per second and be like, hold on, something's moving too fast, right? And so there's this almost ideal frames per second that the human mind interprets as the natural flow of time. And that's, of course, subjective to humanity, right? And of course, if you're a bee or fly buzzing around, then it's much slower, and that's why we can't hit flies with a fly swatter, because they see it coming really slowly, right? They run at a different frame per second, and so they watch different movies, right? I mean, that's the idea. And what's funny is, going to the movie analogy, is like you think about like stopping time is hitting pause, right? So we're watching a movie and it's all flowing, and you hit pause, and like boom, there's this moment, and you're looking up at the screen, and the person's face is mid laughing, and so their mouth is giant, and you're like, you've just frozen time, and no, you've hit pause, and it's on that it's on that frame. To me, that's, once again, it goes back to all that we're talking about. It's the calculus, it's the convergence of that. We've just stopped it at that moment and found the derivative.
Yeah, and we'll definitely bring it back around to trading. But I was thinking about when you're saying it that way too. The speed is like of when it's frame per second. I think Annika also uses that thing when she's talking about with somebody hitting a tennis ball. You have all of these different inputs biologically coming in, and then the brain blends them together to seem like it's one instantaneous moment. Or like I think about our ability to reaction times. I think is like 250 to 300 milliseconds. And so people will tell kids like playing sports, like if it's somebody in soccer taking a penalty kick, or it's a pitcher in baseball, they're like, well, watch the ball and react. And it's like, we actually can't react that quickly. We don't even have the reaction time. So you almost have to pre-guess. And that's why it's interesting is like, allegedly, like with baseball pitchers, I always think about that steroid use will actually improve our eyesights. So maybe at the release point of the pitcher, you can actually see the seams on the ball, and then you're already swinging based on the seams on that ball, based on our reaction time. So actually steroids maybe improve your eyesight, which is actually the benefit versus the musculature. But that's just a random thought of my own. Or same with soccer with penalty kicks, is like the goalie actually has to choose the direction before the kick is taken. But we tell kids to like watch the ball and react accordingly, and it just doesn't work like that.
Yeah, I mean, I think what works is our experience over time, playing a sport. And so
Right.
you see someone kick it. Before you've even watched the ball, your brain has you've seen people kick thousands of times. And so when they kick, that ever so slight angle of that person's leg and the tilt of their shoulder, before, like, as their foot contacts the ball, you almost know the direction because you've seen 10,000 kicks, right? And so that's really what is experience. It's the repetition of experiences that of events that allows our brain to much more rapidly crystallize what will happen next, right? Or forecast rather what will happen next. And what's interesting to me is when we talk about what the brain can and can't do and almost slow down time like a professional athlete might, is I think of times in my life where my brain has slowed down time. And I'll give the perfect examples is during accidents. Right, and I'm sure each one of us have had this, right? And I've been in a car accident where one of the worst in my life. I was a teenager, and wasn't me driving, but the car flipped, and I went through a full multiple 360 flip in the air. And I mean, I remember that time slowed. I was lurching through the air upside down, and man, do I remember every one of those moments? It's almost so. I talk about the fly or the bee. I felt like that, and it's just click, 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 and we were running at 10 frames per second, and then slam, and you hit the car hit, and I ended up upside down, hanging from my seatbelt, and got out unscathed, luckily. But that experience, I don't. First of all, I'll never forget that. But what's amazing is that the brain does that, and the shock of what you're going through does slow time, which means that our brain has the capacity to. Whatever would have happened, like there's that, and there's other similar events in my life. I also got into a bicycle accident some years ago. I got hit by a car while cycling, and again, I still remember the slow motion of flipping over that car, and I was like airborne for, it could have been minutes, although it was probably half a second. It's fascinating to me, and I feel like that obviously disrupts this concept that there is some fixed idea. Our brain has the ability to, therefore, I don't think we can turn it on or off. Maybe we could learn to, I don't know. But that to me ties into the athlete or the sports analogy you were using, which is, our brain can process at much more interesting than we typically do, because it's shown to have done so on different occasions.
Like you're saying that when the athletes are, through experience, are chunking information, right? And then they're able to quickly kind of intuitively assess that information, and their body can react even based on that chunking process before it happens. I had a very similar experience with a car accident when I was 16, and it was my fault. It was like in the snow, and I was going too fast, and I was late for an event, and flipped a car, and luckily everything unscathed, and everybody was, myself was just the only one involved, and it was fine. But I felt the same experience, that it felt like time was incredibly slowing down. Like I had all these thoughts, and like felt like minutes passed in a split second. But I wonder also, I can't help myself to push back and wonder if it's true, or else I'm just misremembering it. And maybe during that vivacity of impression, it had like such a strong impact. I felt like I was feeling all those things, but maybe that's a hindsight narrative fallacy. But I'm just curious if you have any thoughts on that.
I haven't had thoughts on that, but I feel like I remember, like, after those events happened to me, it was so clear in my mind that it had felt so slow. I kept on thinking about it and thinking about it, as we do, or I'm sure you did after your accident. That, like, there's no way somebody could have convinced me that was all in my mind. Like, but obviously it was, because time still moved at the rate time moved, right? Nothing's changing in this world because Wayne got into a car accident. Like, how much ego is that? That's ridiculous. The world does what it does, and we just live in it. But to me, I think there's obviously some form of change, chemical change, if you will, associated with the adrenaline or something that happens when you're in that highly anxious moment. Maybe adrenaline heightens our senses, and so we're so alert to every piece of information that's flowing in that it feels like slowed time. That's possible, right? So that's where that might overlap. But I'm not sure. Obviously, afterwards, we always create these narratives. That's what we do once again as humans, right? It's like everything is self-reflective or in a way tautological, right? We're human, so we see things from a human side, and what that means. We can't look outside of ourselves. We can sit here and talk about it and have fun with it, but at the end of the day, we're subject to our nature, our
Well, I like
physiology.
where you're headed there. Because one of my favorite books is The Rise of Superman by Kotler. And that's about the idea that he views that extreme sports athletes are at the forefront of where our brain functioning is. And it's almost like the same kind of question throughout the book. The underwriting question is, how do we get into flow states? And usually it's like, if your kind of life's on the line a little bit, that adrenaline's pumping, so you're getting all of those chemical, explosion of chemicals throughout your body, and that's what helps us get into that flow state more. So it's like he's always talking about, you have to stretch your abilities. There's got to be a bit of risk involved, and all of those sorts of things tend to what maybe increase our hormone levels, which puts us into that flow-like state where maybe we're more assessing our surroundings than being caught up in our own thinking processes. But that one's always, sorry, go ahead.
Yeah, no, I that strikes a huge chord with me, and I'm going to bring it right back to the world we're actually in, which is trading and finance, right? So talk about like heightened senses when markets are going crazy. And I know myself as a trader, there was a time where when I was a younger trader, I used to sit there and analyze, and so like look at the stock and its behavior and the pattern and deliberate over it for days, and like this move and what do I expect. And now after 25, 27 years, however long it's been of doing this, like I see something and like in an instant, my brain, I'm like, I like it or I don't, right? And I could analyze 10 times longer and I still go back to, I liked it an hour ago, right? And it was, and you can ask me, well, what did you like? I'm like, well, all this stuff that I've been doing for 27 years, I saw it instantly, right? So that's that analog of the professional athlete. Is that you've been doing something long enough, you recognize all those patterns, and then something crazy happens in that world. So in a sports game, of course, that's let's say a major competition. It's the Nationals or whatever, some major game. In trading, it's something's nuts is going on in the market. Like S&P gaps down 8%, and like instead of panic, I go into this like hyper alert mode, which is all the information, which is taking all the information I've learned over the years and my experience and saying, okay, what's the right thing to do here? And I find that fascinating. It works really well, and I could go back and question myself after I've made a decision, and however much analysis I do, I find like my body or my mind collectively knew it. And the higher the stress event, to the point you were saying, the more it feels like it knows it quickly, or quicker. So that ties in really well to what you were saying. What did you call it? The Superman? I don't know that book, but it feels like the same concept.
Talking about like athletes and their ability to chunk information, we got cut off for a second, so we're jumping right back in. Is the idea that like you were saying, that intuition? That's what I was actually going to bring up with you, and you led perfectly there. I was taking notes on what you were saying. I was like, intuition was kind of my next question, and I think you and I personally talked in the past about Chronos versus Kairos. The ancient Greek philosophers used to talk about Chronos is like clock time, and then Kairos is like the opportune moment. And like you said, especially when we're trading, and especially in volatility and derivatives, is time can speed up or slow down, and it contracts and expands, and that really affects especially derivative options. But the interesting thing, like you always reference your quant too, but like if with decades of quant experience and chunking information and chunking different forms of market experience, like you said, when something happens, you have that gut intuition that this is the right move here. But then as a quant, you maybe couldn't formalize or codify that into a trade. So I'm just wondering, like, the competing parts of your brain, like, how do you deal with that in that moment of like, I know this is the right move, but if I had to come up with a rational reason, it may be way too late and I might be fooling myself.
Yeah, I mean, so that gets into this whole other subject of what it means to be a quant, right? A quant to me is seeing and approaching the world in a quantitative or analytical way, right? And so let's go with the example or the question you ask, right? So I see a trade, and instinctively, I've been around this for decades, and so I'm like, oh, this seems perfect. And then right away, the quant side of my brain says, hold on, Wayne, this is one data point. Like, right. Don't leap off the cliff, right? You don't know if there's soft ground below, right? So those are the competing minds, right? And so then the more quant of me says, well, everything in markets, we use empiricism, but empirically we don't have a million years of markets. We have, at best 30 years of options testable, maybe 20 something, maybe the 1987 plus. But the point is that no matter what, we're using limited data. We don't know the full shape of these distributions. We don't know the true behaviors of what might be just chaotic environments, nonlinear environments that can't be modeled or forecasted. So I have all this quantitative information in my mind. Hey, there's limited data points. Hey, we only have as much data as we have. It's only just a representation of what might be, right? And then I have, hey, this feels like a pattern I've seen before, knowing that it's a small sample pattern, right? So I have to take all that information and say, let me make a decision. And that's, I think, what happens faster or slower given the event. In slower moving markets, I'm going to be more leaning to the quantitative side, which is, let's trust that this typical behavior will persist. In these faster, weirder markets, I have to say, hey, let me go with my gut, because I don't trust empiricism as much, because this is anomalous behavior, and I believe my brain is doing a little bit more because it's including the fact that it's anomalous behavior with what it knows is the traditional behavior, right? And then I'll conclude all that by saying that every quantitative model is still the representation of our subjective findings, right? And so, I know that the best model I make, and I've systematized this process. Well, the process I systematized was what the patterns I was seeing for years, right? That's all that's been systematized. So is it a model? Sure it is. It's a model of a bunch of patterns that I thought seemed to be persistent by my judgment, right? And so I know that model might break, i.e. that seeming persistent pattern might change. So that's how I see it. What do you think about that?
No, I appreciate you admitting that, because I think we've talked about this before too. Is like the idea of a quantitative system is really just an amalgamation of subjective experience over a certain amount of data sets, and so everybody's like, "Well, I'm fully quantitative," and I'm like, "Well, what about the person that created that model? That's a subjective experience, humanoid, And they're like, "Yeah, but like that's what you have to deal with." So like we always talk about, there's the idea of combination of cyborg, right? Man plus machine, right? You can use quantitative models, you can use large data sets, you can start to codify the way you think about everything. But then, as you said, when Chronos turns to Kairos, do you think that's the point where you have to get in touch with those gut intuitions, because you, in the back of your mind or subconsciously, know that my quantitative models were designed off a certain data set, and we may be outside of this data set's experience. And that's the human overlay, knowing I only had a bookended data set, and now we're in a phase shift environment where that data set may not be no longer applicable to today's markets. And like in that sense is like when Jim Simons at different points, he's actually like pulled the plug on Rentec, and his quants get very upset with him. But what do you think? Again, that's just his gut intuition that goes, hey, we think we know 99% of it, but this is that 1% environment, and therefore let's just pull the plug and or like you're saying, or go with your gut intuitions and try to navigate that in a more second by second basis.
Yeah, and then the humor of that is that you later codify that event. And you
Right,
say
of
that
course.
part of our model is that 1% of the time we turn the off knob, right? And so
Right.
we have this 99% this and then 1% that, and that's our model. And that's now the model, is that we gut turn it off. And so, people call that discretionary overlay, and people call that a bunch of different stuff. And then people who codify their discretionary overlay some years later call that part of their model. But it's all the same. It's just different ways of talking about the same thing. And that's it. I mean, we have to realize that at the very core, we're dealing with unknowns, right? And you and I have talked about this before: the known knowns and the unknown unknowns, and all that great quotation going back to that. And so we know what we know, and most of the time that seems to pan out. And then every once in a while, things get really wacky, and when it does, time slows down, right? That's what we experience. And then our senses get heightened with the adrenaline or chemicals that are going on in our body. And then we make a judgment that part of our model is we have to overlay this discretion based on our experience, which is its own model of our life's experiences.
Part of that, you begged an interesting question. I think that, like you said, black swans are inherently unpredictable. So I can't stand when people talk about black swans. We can talk about gray swans that are semi-predictable. Like,
Sure.
History doesn't repeat, it rhymes. But then when something does happen and then we put it into the quantitative models, like you're saying, is like, take an example like COVID or the 87 crash or anything. Is like, should you put that in your quantitative model when you know it's maybe a one-off effect and event and maybe affecting the data set and the trading styles you're looking at? Like, I think about a lot of times when even trend followers, right? Like that COVID event happens, but by the time, so they're trading their models based on that event in the data set, and then depending on their look back period, eventually gets out of the data set, and then the distribution completely changes.
Sure.
So it's like, how much should that affect your distribution, and how much should you include that event? Like you're saying, like it happens 1% of the time. Is the future going to have an event like this, or it'll be completely different? And should I include that in my models or not?
Yeah, now we're talking about the big questions.
Right, exactly.
Go refer to the quotation in my last monthly letter about big questions. That was Leonard Susskind, who's, we can ask the big questions, but it doesn't help unless we can actually test them, right? Experiment. And unfortunately in finance, we can't. We can't test the next pandemic, all right? And so go with what my theory is on the question you're asking. I obviously, I've thought about this a lot. I've thought about it for well over a decade. It's the big problem in finance, in lots of arenas, but particularly in finance with the market dynamics and versus, let's say, more pure science. You can study in physics things that will tend to be a little bit more repeatable, right? Not in markets. So I find my general consensus is that the behavior of humans tends to be the same, right? And so human behavior, you can, if you will, trust to be repeatable, right? Because people just always are the same, and you can go to any century. And I always laugh when people say, "Well, back in the the 1960s or back in the 1800s, people were." No, they weren't. They were just like us, right? They just wore different clothes and had different technology, but they still had the same feelings when they went home at night, happy or sad, right? And those emotions, obviously, fear and greed, led to the obviously the tulip mania of the olden days, and all the different manias before that were not even recorded. Sometime back in Rome, there was some mania of something, right? And it wasn't Bitcoin; it was Rome coin, right? Right. So, in that way, I find that what we can model of human behavior, we can rely on, and so we do our best to try to extract what's behavioral and what can we trust, and what's and versus what is just noise. And I know that seems like an impossible thing to extract or to bifurcate, but that's what we try to do as quants. And so now you come back to the question of distributions and what do you trust is we have the whole distribution of all of time. That's how we do it. And then we have different period distributions, right? And rolling. And we actually have a tool that squeezes and expands the duration or the time used of that distribution, right? So we say, hey, let's look at S&P behavior from 1980 to 1990, or 1980 to 2010, or just 2009 to 2010. And so it's the same data. We're just starting and stopping the beginning and end points, right, at different places. And you see how that distribution evolves over time, and the if you will, the distribution of those changes can help peter out what's consistent and what's not. And so for me, it's some combination of looking at the total distribution, i.e. all history that's ever happened, looking at different frames of the distribution, local and some wider term and different sizes, and then seeing the similarities are ones that are the most reliable. And when I say that, I think of this other concept of fractals, which is like self-similar behavior, right? And self-similar at different sizes, right? Scale is what's called scale invariant, right? So it doesn't matter; it's always the same at every scale. I feel like that with this is the same with price behavior in markets, right? And you could almost say, if you look at a minute chart or a 5-minute chart or a 30-minute, an hour, or a daily or a weekly chart, if you see a similar trend and it's all uptrending, then it's more reliable than if the short term is downtrending and the long term is uptrending. Then there's a conflict between two time frames. So the meeting of time frames, and similarly meeting of relationships of different size distributions, to me is the human behavior part that doesn't get extracted. And where they don't meet is the anomalous part that I will call noise. It's a broad answer, or it's a long answer, but I hope that congealed in your mind or makes sense.
Yeah, I want to maybe talk about specific, because it'll help us flesh it out a little more. I'm thinking about scale invariance, or the opposite of scale invariance. It's like, just changes at scale. I think Taleb's been talking a lot about lately is like, like communism at the family level works, but not at like the national level, because it has scale variance to it, right?
Totally.
But then when you're thinking about is like, and this is why I think you're right, this is probably the hardest question for us, is the idea is like human nature doesn't change, right? We're very emotional creatures, and you can see that kind of patterns throughout the long arc of history and trading and investing. But then, as you know, we both operate in vol space. And so vol surfaces are constantly undulating, but then more important, you have different players on the field. Like you can't backtest a long history, because you have till 2010, you have the rise of the VIX ETPs, which changed that market dramatically, because you have different players entering the market. And then I think even at a smaller scale, let's just take 2020, for example. You have March 2020 happen, you have this huge sell-off, this huge pop in volatility. But then for the rest of the year, you kind of have the echo of volatility from that. And then now we're going into a contentious presidential election, where last time most people were surprised by Trump's election. So now we have kinks in the volatility surface that are dependent on the previous election, but then tied in with the echo of volatility coming from March 2020. So like these are very on that small scale, like you're saying, that are deviating from maybe the large scale. And so like, how do you deal with that though, with that scale invariance?
That's a good question. Once again, I mean, you're talking about the deviations are, from what you've described. I'm going to re-summarize as like overlapping independent events, right? So COVID happens, and then there's an election, right? Those are obviously unrelated, and they happen concurrently in time. And I remember actually when COVID first happened, March of 20, I remember a few weeks or within that month or two, there was some big event in the oil world that something happened, and it wasn't yet Russia, Ukraine, it was something else, and it was that weekend right during the COVID meltdown, and something went wrong in oil. I'm like, wow, this was like an event in an event. I felt like I was in the movie Inception or something, right? And so that's what's happening. It's like, what is this event versus the first event? Everyone's already nervous. They're not going to get double nervous, right? The world's already ending from a pandemic, and it's killing us all, and that's the mindset at that moment in March of 20. So what does it matter that now, like some oil field was shut down or something, right? And yet it did. The market still reacted. And so, to your point, there's these overlapping events. There's sometimes within the other. There's sometimes a little bit of time after the other. We studied vol behavior over years and found that vol events that occur, or crisis or stress events that occur within some time frame after a prior, are not as reactive to as that time frame fades, right? So it's the memory of humans, right? And very simply, like if something awful just happened, let's say Feb, March of 20, and there was COVID, if in July or August of 20, something else terrible had happened, it's like, okay, we're already in terrible. How much worse can it get, right? And it's like, and so the vol doesn't pop as much or doesn't react as much because the fear is already there. Had it been 7 years and nothing had happened, then suddenly a global pandemic, oh my gosh, like it's like nobody ever remembers when anything was bad. And so this fear just goes to the roof. All right, so the overlapping of events definitely has an expression in the output of vol's behavior and the vol surface, because once again, the traders of vol, as the traders of the markets, are humans. And humans tend to have this experience of more panic, but when they're in a panic, they don't get as panicked the second time as quickly, right? So we go back to human nature being the defining, not behavior, but the defining characteristics of all markets, including volatility. And so once again, if you understand human behavior and you have some reasoning around why people or how people should behave, then you see it reflected in the markets. And if that lines up, then you can begin to extract and say, okay, we shouldn't expect as much as a pop because we're in the middle of a pain already and people are therefore not as sensitive. Then I'm not going to expect it that time. And so when vol runs, we're going to be more likely to want to revert that pop than trade it for an expansionary payoff. So there's where knowing the behavior and having that thesis beforehand and understanding that that's where everything comes from and is repeatable will drive investment or trade decisions.
Got it. And I was even more pressing on the idea of, like you were talking about, signal to noise ratio. It's like, if we look at thousands of years of human history, we get one understanding of like emotions, and then maybe 100 years of history of like, kind of broader financial markets in general, and then maybe a 10 to 20 year history of actually, vol instruments being traded. But then this is tying into like the hardest question is like, how do you then decipher signal to noise ratio? And that's what I was saying, especially when you had overlapping events or events within shorter time frames, what you would consider noise initially in a different environment might be signal in this environment. So like, how do you differentiate between what is actually signal and what is actually noise?
Yeah, I mean, so to your comment on instruments, that was in your last question. I didn't address it, and you repointed that out. Is so the different instruments to me, or if you will, the evolution of the volatility markets with different ways of exploiting volatility, I actually don't pay much attention to. And I know that sounds nuts because I'm a vol trader, but what I mean by that more specifically is that at the end of the day, it's all vol, right? It's so you can create a structure and step it on top, and we saw what happened in Volmageddon in February of 18 when that ETN, or was it ETP? I forget what category of product it was. XIV blew up, right? And so XIV had a particular structure to it that wasn't stable. Based on the way they were trading it inside and the leverage they were using, etc. Right? So it blew up. But underneath it all was an exposure to vol and let's say VIX futures, which have so much volume and therefore so many traders per day reacting, right? So we can study XIV as this overlaid structure around the thing, or we just study the thing underneath it. And so I guess what I'm trying to say is what happened to XIV is a function of what was wrong with XIV as a product, right? It was a structural inefficiency. And that to me is a different side of arbitrage, or it's studying the documentation of these products and seeing where is their error in the way they've created this thing. Is it the way they roll? Is it how much leverage they're using? Those are structural inefficiencies to potentially take advantage of. But as far as the vol that's happening underneath it, that's the world of volatility. Like, it doesn't change, that product doesn't change how many people are buying and selling protection on the S&P per day, right? It's expressed in, the surface of vol, or at least the front of the surface, the near term is expressed in the VIX and going along of course from at the money to the tails, in and out. You see the shape of that smile by the pricing of the VIX. Or you can just go look at each S&P option up and down the chain and say that's what's happening. And the VIX is some byproduct of all those options that's taken a certain slice and called itself the VIX. I don't care to look at that slice and call it the VIX. I care to look at the underlying options and see the shape of the entire surface and how it's undulating over time. And that, to me, is the most information, because that's what everything else is relying on to be who it wants to be, whether it's VIX or XIV. Does that better answer where you were going?
No, it's great. And along those lines, like when we had the rise of retail traders that were buying calls or YOLOing calls on meme stocks,
Right.
do you think like in that sense, like you don't need to pay attention to that either because it's going to be expressed in the S&P options and that's what you're trading anyway?
For me, yes. I mean, you could pay attention to it and say, okay, GameStop calls are behaving like this, and their IV is priced at X, and it's 3 times what it should be priced at. I mean, we can make those assessments based on the history of implied vol of GME, the stock, right? So we can look at the realized vol of that stock and say, okay, it's now trading here, so there's this excess buying of calls that's overpricing what calls should be paid for, right? And so it's not a good trade. We can make that assessment. To me, I don't really care. I don't trade that. So I didn't trade that. I don't want to trade that. But certainly there are people in the world that can say, well, that vol is overpriced relative to its realized, and say, that's a good trade, and I agree with that, and go do that. And the world's so big in finance, there's space for all of us. And so sure, that has some logic to it, and I'm a fan of that logic. But to me personally, like, that's just GameStop. I don't want to pay attention to that individual stock. All I know is all 500 constituents of the S&P will collectively create S&P vol, which is the best representation of mass consensus because it's got the noise cancellation of all 500 constituents. It's got the high volatility tech stocks and the low volatility industrials, and they're all coming together to show us the behavior of this index, which therefore must be the best version of mass consensus because it's everyone's at every sector's input, and on that surface, who's buying what options and how's that shape of the option surface behaving, that to me is more of a fair representation of what the world is thinking. And let me say it also in this way, is that you talked about signal to noise. The more granularly you look at anything, whether volatility or just in regular trading stocks or indices or whatever you're trading, any asset class, the more granularly you look at it. Let's say, hey, how's the vol behaving on GameStop relative to its past? That's digging into, to me, more noise because it's so singular, so related to what's happening on some Reddit, right, or some external thing in the world with some retail people who might shift tomorrow, and I have no idea how they behave, right? So that granularity is primed for more noise. Whereas when you look at the S&P, it's more signal because all the GameStops are going to noise cancel the non-GameStops, and you're going to have really the behavior of the broad institutional market. And therefore, I say if you want to not risk decreasing signal and increasing noise, you want to look more broadly rather than more granularly. And that's true in any statistic. The more you try to fine tune, and like think of curve fitting, right? The more you try to fine tune your model with more variables or parameters, the more it's subject to be overfit, right? Because you create noise with more precision. So it's the same thing when you study the one strike of vol on one particular name in the market. Like it's like that could be literally one institution moving it. It doesn't tell us, quote, what's going on at large.
Yeah, I was thinking about also though more in like the aggregate is if you have a higher demand among single names on call options, that can start to change the skew on SPX, that we move from more of a skew to a smile. But would you argue that if you're trading near term at the money straddles, like then that skew or smile, whether it's a smirk or a smile, is not really going to be affecting near the money at the money gamma scalping? Is that fair?
Yeah, it shouldn't be. I mean, that's part of the point of ATM scalping is you don't want to be, and you're not affected by skew. You're affected by that smile moving up and down, right? Vol, the entire surface lifting and lowering, right? But you're wanting to not be affected by skew. That's one of the reasons you want to scalp. And I mean, there's more gamma at the money. There's the most. So that's why there's a mathematical rationale to scalping at the money. But the collateral benefit is that you don't have to be as worried about skew behavior because it shouldn't affect you.
And then part of that, when we're talking about like at the money and gamma scalping, is we're talking about signal versus noise. And what I find very interesting is if like you're daily gamma scalping or daily restriking, you're going to get a lot of more at bats. You're going to get a lot more data on those trades. And if you think about it in context of tail risk hedging, people buying deep out of the money options, and maybe that they only get a payout once every 10 years, is like they have to perfectly model and perfectly monetize those positions, right? And you're only getting that opportunity maybe once every 10 years, and it's an anomalous event. And like we've talked about, vol will cluster, but vol will mean revert just quickly, and you can lose those profits. So is that like part of when you think about that philosophy of being a quant and reducing signal to noise ratio, is that if you're trading on a daily basis, you actually can collect real data. Whereas if you're just buying teenies and hoping for the 1 in 10 year event, I think about this often, is like that drives very different distribution of returns and very different distributions of what you can count on how to monetize over time.
Absolutely. I mean, of course, it's a very different distribution, and of course, I mean, everything you're saying is right, right? So, with an ultra rare event, you have a incredibly low hit rate and incredibly high potential positive skew, right? So you have both things going for you, and with lower hit rate comes higher positive skew potentially, right? But then, unless, to your point, given that you monetize, right? If you don't monetize, then your positive skew immediately is gone, right? And it's gone in a day when there's that massive mean reversion of overpriced vol, right? And VIX goes to 80 or IV goes to 80, 90 in some event, and the next day it's 40, right? It's that 50% reversion in a single day on that massive recovery rally on whatever day that comes, and inevitably it always comes, right? I think that was March 21st or something of 2020, somewhere around there, that 10% rally day. So if you didn't monetize within a few days before, you've given back half your profits in an instant, right? And so to your point, not only are you living on the rarity of the event, is you're living on the super high reliance on monetization skill, right? And so to that risk is you're so potentially, there's so much need to monetize correctly, there's probably a greater likelihood you monetize too early, because you can't risk not monetizing, right? Unless you have a mandate that says my strike is, let's say 50% off the S&P, I'm going to monetize. And then if it makes it to 48%, you have no realized P&L. You didn't make anything, so you have no positive skew, right? And if it got to 51 and you monetized right at 50, and then it went down further, then you didn't participate in, quote, the rest. And wherever your strike is, that's the same decision. So the problem is, as it's getting there, you're so in need of that positive skew payoff for that 10 years of waiting that, to me, you're inclined to monetize sooner if you don't have a rule. Now go back to what you're talking about, ATM and daily or higher frequency gamma scalping, is you have a high hit rate and positive skew, and those two things usually don't go together, right? And that's what's beautiful about it, is you can establish a reliable hit rate. You do this daily or multiple times a day, so you're clocking your trades, and you have empirical evidence for how you do scalping. And you say, oh, look, I've got a 54% hit rate. I've got a positive edge. Great. And you do that over years. You know you have an edge, but this whole time you're holding a positive skew payoff. So when it really pays off and there's that COVID event, then you do excessively well, because you're in an option. It's that simple. And so, to me, there's no better way. That's why I do what I do. There's no better way to have a reliable positive expectancy and embedded positive skew. Like, what else is there in trading? And I know there's millions of things to do trading, and I'm not criticizing anybody's trading style or skill or strategy. I love it all. I love the financial markets, but I mostly love positive expectancy, high hit rate with positive skew. It's so hard to do, but conceptually, that's the gold. And that's why we live to try to do that better.
And nothing's perfect, so there's always trade-offs. And like we were talking about, whether you're buying those tail risk teenies, you might miss out on a lot of that convexity that if you're buying like at the money straddles. And then the other thing you may be slightly more concerned about, especially if you're doing it long vol only, so we should maybe talk about why long vol only is the key. Because if you were incorporating short vol to pay for long vol, a lot of wonky shit that can happen that you've never seen in your data set before. So that's why I know you try to stay away from it. But the other part of that is, if you're restriking on a daily basis or on a time-weighted basis, you might miss out on a persistent trend in vol, or capturing that move if it's not quite as explosive. So maybe talk to me about like the both the positives and downsides of using only long vol, but then also by constantly trying to monetize and restrike, you don't maybe sometimes capture the full breadth of that move.
Yeah, sure. I mean, the devil of monetization is missing out, right? I mean, ask any trader, and they're like, well, this thing ran, and I got out, and I made 20%, and then it ran another 20%, and are you wrong? Right? And half the people say, well, I still made 20%, and the other half, well, I could have made 40, right? And so the glass is half empty or half full, right? You made 20, but you could have made 40. You monetized too early. That it's not just vol. That is the number one quote issue of trading, is when do you get out? And it's easy to get in and hold forever. And sure, you can be a long-term holder and buy the S&P and see what it does in 50 years, and you'll be fine. Right, but for those of us that are daily trading or in the markets in real time and trying to make P&L on a regular basis and manage a portfolio, well, yes, there's the skill of monetization, and versus the devil of missing out is always what we're trying to hone, right? And so if you ask me, I think there's a good equilibrium there, and we like to do it probabilistically, because quote, there is no right answer, right? So you have these two forces that are pushing against each other, right? Good and evil, right? And in this good and evil world, good being this convex payoff, and the more you let it go, the more it's going to go to the sky, and evil is missing out on that upside, right? If you want to play those two sides. Now, so we say, okay, we don't know the right answer. We could get out of it today, and tomorrow could be the reversion, or we could hold some more, and then we could lose some of it tomorrow. So let's get out of some, right? It's always like split the baby, right? And so does the baby split in the middle? Should we get out of 50-50, half our position? No, I say let's do it in the best way I know how, which is probabilistically, i.e. the more confident I am that we're close to the end, the more I want to take off, right? So that gets back to what is the shape of this distribution? Where are we in this distribution, right? If the S&P, if we look back over 100 years as an easy, broad theory, right? If every time it's ever sold off the most, it's been around 50%. And we go back to the Great Depression, we go back to the 2002-3 correction, we go back to 08, the credit crisis, COVID, like all of them are, let's say, between 30 and 50%. 50% is around the max. So to me, at 50%, I'm comfortable finally liquidating everything. I'm left with nothing. And you're right. If it goes down 55, I'm just sitting, I'm staring at it. And I'm like, didn't get that last 5%. But probabilistically, I've made the right decision. And if I sold everything out at 10% down, well, that's silly, because so many times it's gone 20, 30, 40, all the way down to 50. So if we use that broad theory, we could say, okay, let's divide that up somewhat equally, 10, 20, 30, 40, 50, and say, okay, at 10% down, well, that's on average, like, let's say 7 out of 10 corrections are 10% down. Okay, so let's sell 30% of our position, right? And then it's down 20%. Well, a lot of them, and so now let's sell not 30% of what's left, but 40% of what's left, because now it's down 20, right? And so by the time it gets to 50, you're selling the last bigger percentage of what's left, because you're at the end of what mostly has ever happened. So we go back to, yes, we can always be wrong, but if you use your best judgment, which to me is the probabilistic assessment of what's ever happened, which relies on human behavior and people buying up markets when they're cheap, then there's some rationale to scaling out more and more as it dives deeper and deeper. And living with that decision and saying, yeah, I missed some of the upside, but you know what? I used my best mathematical / quantitative judgment to get out of as much as I can along the way at the right time. So that's how we approach it, and we don't believe it's, quote, right. We believe it's thoughtful, and we understand the downside and the upside, and we accept that. Therefore, that's how we move forward with it, and we try to get better at those probabilities over time.
Yeah, and I think whether it's, when you're out at negative 50% down, it goes down negative 60, negative 70, that's one thing. But the other thing I think about is like it just at a high level, theoretically, like take like this year with like a grinding down market, by restriking daily, let's just say somebody's buying a straddle and they're buying just theoretically, just systematically puts and calls, is like you may be monetizing those deltas on the puts, but when you're restriking with the calls, as it continues to trend down, you're giving a bit of a drag by always buying those calls if it consistently, trends in that direction persistently. And my argument has always kind of been is like, yeah, it's inherently kind of mean reversion to be restriking that, but at the same time, you're also daily monetizing the trend. So you may not be getting a full monetization because of the drag on, let's say, the call side, but you're still monetizing and you're still restriking for if we see an environment again, like you were referencing, whether it's the 1930s or 2000 to 2003, I believe from that period, we had like 7 rips of 20% higher. or 20% or more as it like dead cat bounces. So that's the reason you put on both sides. Is rarely do we see environments like this that we've seen this year where it's just persistently grinding down. And so there is a I don't want to call it downside. There's a trade-off to putting on that straddle when you have persistently grinding down markets versus ones that are volatilely like mean reverting as they grind down.
Right. So I think what all that I think about as you're saying that or giving that example is right skew, right skew, right skew, right. And
Yeah.
what do I mean by that is you could be wrong 99 times, and then the day you do that same scalp, and the next day there's that 11% rip. You've made back 101 days that day. Right. And that's why, to me, when you live with a right skew instrument, i.e. optionality, if you can manage tightly that quote way down, and you can you can be wrong 99 times, and the 100th time pays for those 99. And I know it's like that's obviously people say that's part of the problem is you could bleed and bleed and bleed until, but if you can manage that bleed tightly and not lose too much, it doesn't take much of quote just being right that nth time to make it all back and then some. And so for us, it's not only do you say we want to monetize, because over time, even in bear markets, there are bear market rallies, there are recovery rallies, there are and violent recovery rallies at that, right? We've seen the most outrageous, and so to me, when I'm restriking, I'm monetizing and getting as close to a positive hit rate, i.e. greater than 50% on that trading. So we're like making money along the way, curtailing the downside way better than the market, right? But still repositioning ourselves almost daily for a right skew payoff for as soon as that event happens, right? And so to me, I guess I like that, and and you could say, well, Wayne, you could keep on doing that until you lose and lose, but it would take 100 years to bleed away everything because we're containing the downside so tightly, right? And yeah, now it's been 6 months in 22, and the market's done this. Is it going to be another 6 months? Like, what's the S&P going to go down another 20%? Sure, anything's possible, but at some point it ends, and at some point along the way, there's a violent recovery rally, right, or a bear and people say, well, that's a bear trap, and yes, it is, but that's what we need to make a few months in 3 days of P&L, right? Because we've repositioned those strikes or that gamma, if you will. We've repositioned to be convex to the next move at the best level and contain the downside, trying to achieve that payoff. And of course, if you believe in what you do, that's what you do. And I'm not saying that we're not wrong doing it. I'm saying we have seen this not quite like this year. There's been a crazy environment where there hasn't been one of these real rallies for 6 months now. But even then, we continue repositioning. It feels like I know this sounds silly because it's the buy the dip mentality or behavior, but it's the more it drags down, the closer you are to that end, right? And it's I understand markets can go down for 2 more years. I get it. Like I'm not saying that 6 months is it, but certainly it's a better trade now being right skew positioned than it was 3 months ago, right? And it will be better in 3 months from now. And so to me, it's all just a matter once again of sizing, of managing your downside, of following your process, of keeping right skew positioned, and of generating positive P&L along the way the best you can. And all of that summarizes, sometimes it doesn't look so great for a few months. Well, so be it. If you believe in that final outcome, and when I say believe, I mean that in a scientific and thoughtful way. If you've done, you've been doing it for decades, you've done the work, you understand what you're doing, then I think it's a very worthwhile risk to take versus what others are doing out there.
We started talking, well, 2 things on that. One is, what we're really saying as volatility expands, what people are really saying is like the expected distribution of returns expands, and people a lot of times think that's only to the downside, but it's to the upside too. So you get those face-ripping rallies. So that's what you want to take advantage of. And then the second one is, we started talking about paradoxes with Zeno's paradox. Is I'm just curious, like how you hold it in your mind, the paradox of like having positively skewed, option trades. But then with restriking is essentially people would argue is a mean reversion strategy. So like, how do you think about, positive skew and mean reversion at the same time? Because a lot of people they would consider that a paradox.
Sure. Well, let me go to the wide world of vol. Is most long vol positioning out there, is some form of vol arb, right? So most long vol has another opposing short leg to it, right? So somebody, for example, they're short the belly, they're short at the money for long out of the money, right? And so they're like, oh, we hold long tail on the S&P and we're paying for it with short at the money, right? And so you're using this rich premium to pay for the teeny premiums, right? And you're getting this positive spread, i.e. you're short vol to pay for long vol. Right, that is by far the most widely utilized methodology out there in the vol world. And I survey that and I say, well, okay, so you're short vol to be long vol. Well, I don't get it. Like, that's counter thesis. You're doing literally the opposite of what you're trying to achieve. Like, I want to, I love this analogy I always give, which is, you want to do the high jump, you don't put on a weight belt. Right. If your goal is to jump high, you take off the weight belt, and in fact, you take everything out of your pockets. In fact, get naked, right? Because you want to jump as high as you can, right? I guess assuming you shave your legs or whatever, right? So, right, you want the minimal resistance when you're trying to leap as high as you can. That's the key point. And so, but the problem with long vol is it's so expensive to carry. So, do we understand why everybody gets short some strike or a calendar spread or a strike spread? Why are they taking those opposite legs, these counter thesis trades? Because long vol has to be paid for. At the end of the day, you can't just own long vol, you'll bleed away to nothing. Okay, so what we establish is that in order to own long vol, people need to put on some form of short vol. Right? And so I say, well, I don't want to put on a counter thesis form of short vol, so I'm going to do an analogous short vol, which is mean reversion trading against my long vol, right? So instead of saying, okay, I'm going to buy a long out of the money put and short some other strike to pay for it, no, I'm going to hold the long vol out of the money and I'm going to mean revert its payoff as a form of short vol to pay for that longness that I own. Right? At the end of the day, it is kind of similar to being short a position, but I'm actually never short. So if there ever is a major long vol event, I have nothing resisting me. I'm jumping high without a weight belt, right? And so when that panic happens, it's 9/11, it's COVID, I'm free. I'm free to leap to the sky, right? And so I love that. I'm not constrained by a short. But if it's with a monetization, that's my way of infusing the mean reversion of infusing a quote short side against my long to be able to pay for that long, because you cannot just hold a long. That's the simple answer. So hopefully that all makes sense, but that's how I think about it in my mind.
I think to put maybe a finer point on it, like if you're using the classical way of people are short vol to pay for long vol trades, is when you put on short vol optionality, you still have convexity to those losses, and then you're hoping that your long volatility convexity will outweigh those. But if you're using a mean reversion strategy, then you're saying then that's really linear losses versus the convexity of just buying the options. But more importantly,
that's a beautiful summary, Jason. Can I just say that again? There's music to my ears. Exactly. But you're concave to gain and linear to loss. In fact, even better than that, because you have losses, stop losses on your trade. Sorry, go ahead. Yeah, I love that. Yeah.
Even better than that, if you're buying options, you have convexity to your P&L, but then the mean reversion side is actually concavity to the losses because of the way options pricing works.
Exactly.
So it's not only do you not have convexity to your losses, you have a bit of concavity to that linear mean reversion. So you're essentially taking linear losses with convex wins, where a lot of times if you overlay short vol and long vol together, you can have convexity to both sides of that book. That's that weight belt you're referring to. It's almost like a progressive weight belt in a way.
Yeah,
like it's not just one weight. Like it'll change dramatically by the force of the movement in a way.
Exactly. Yeah. I mean, being convex to gain and concave to loss is the beauty of optionality. Yeah. Like that's it, right? And if you talk to most traders who trade Delta One assets, right, who don't trade options, who trade stocks or indices or whatever it be, futures, all they want to do is let winners run and cut losses quickly. Like that's the general trading theory out in the world, right? I think most traders would agree with that. Can't imagine anyone who wouldn't, right? So they're creating a concavity to loss and a convexity to gain synthetically. that's what trend following is. The winners ride the trend for longer. You're convex to the gain, and then cut your loss with a stop loss. That's concavity to loss, right? So by being in an option, you're just letting the instrument you buy do that all for you automatically and instantly, and not being subject to gap risk, right? So you have a quote better instrument, and you have to pay for that instrument, which gives you all that you want as a trader, right? And so the way to pay for that instrument is some way to short vol to pay for that, and you either do that directly short vol, which creates the opposite with convexity to loss, right? Or you mean revert vol, long vol, which is linearity to loss, and so that's where it all balances out.
Yeah, and like you were saying before, when we were going back to like emotions and being a quant instead of like maybe an emotional trader, is that's the beauty of options, is like it's almost that forced stop loss. So it's behaviorally forcing you to have that concavity to losses, or that predetermined price level that you paid for that premium is your actual stop, without having to worry about emotionally being able to put on the stop or avoiding that gap risk. And so we're recording this on July 19th, 2022. And you started to hint at it and everything, but what do you think? Because I read your newsletter, so I know, but I want to hear your thoughts on what's kind of happened in the vol or long vol space kind of year to date, or what's your take on it?
I'll say read my letter. No,
I highly recommend everybody. Is it logicafunds.com, or I should know exactly what's your website?
It is. I don't know that we post our monthly letters up there.
Do you not post that?
Yeah, I don't think so. I got to double check. I should know that, of course, but I think for compliance we might not be able to post our monthly letters. And I
wonder if you blacked out returns and just had the commentary, you might be able to post it. I'm just thinking out loud. But in general, I think people have been disappointed by certain long volatility strategies, or some have done well, some have done poorly this year. But I think on your latest letter, you were talking a little bit more about vol. So maybe we can get into that a little bit, of how you view the market year to date, and how vol affects the market, and vol close to close, but maybe intraday even.
Yeah, I mean, we've just seen what we were talking about in the letter is having seen some a range of anomalous behaviors, right? And I was talking about earlier how we look at, we could look at all the different instruments, and then you could just look at the core, like what's vol doing, how's S&P moving, and and then you have the realized vol, which is of course the history of what it's done, and you have implied vol, which is how it's priced right now based on what we believe is people's assessments of where they think it's going, right? Oftentimes thought to be predictive, but really it's not. It's just the price of where it is right now based on people's assessments, right? So if you look at the behavior of realized versus implied, we've seen these crazy divergences this year, which basically like the market at times looking more volatile, but the fear or the assessment of where it will be going the opposite way. Right, it's almost ridiculous. Like things keep on getting worse, and you look back in your rearview mirror, and they're getting worse and worse and worse, and the wave's getting bigger. It's about to crash on you, and then look forward, and it's getting like less priced, right? As if like the worst is now all behind us, and they keep on saying that as the wave's approaching behind you, and you're like, when are you going to drown, right? So it's almost like, what the hell is going on, right? And so that's what we try to convey in the letter, is that these are massive divergences between realized vol and implied vol in terms of not just their directly, but their vol, which implies that they themselves are choppy, if you will, and that it just shouldn't be that way. And I'm trying to think of how to give an analogy for this. It's just that the things that we typically have seen in all years that we've studied vol's behavior, which we've studied over the last since about, like, most of our data goes back to right after 1987. That's when options really became mainstream and usable and studyable. So we have data sets all the way back then, and we've just never seen so many divergences versus since then, right? So that's been, let's say, 90 to now is 20, 30 years. Sorry, 30 years plus. And so, and when we look at vol itself, we see one thing, and then we look at vol and we see even more divergence. It's not that means something powerfully in and of itself. It's simply the fact that the more places we look, you open the car hood and you look at the carburetor, and then you look at the oil, and then like even the window washing fluid is the wrong color. You're like, why is everything wrong? Right? And so that's really what we were trying to convey, is nothing looks normal. And we study all this because to us, vol itself has a behavior and vol of vol has a behavior, right? So when vol tends to be in a state of reacting, it has a certain volatility itself. It moves up and down to some degree, and then when there's a breakout, those up and down moves of vol itself are larger, right? And those two things should kind of move together. And when they don't, it's like, there's all this bad happening, but people aren't really scared. Like, that's the way to interpret it. And I don't know. There's many ways to talk about it. I don't know what exactly, you want to get out of this, but it's, or where you're trying to, what part of my answer you like or don't. So I guess I'll go back to you with that next. But that was, I mean, there's so many things, so many directions I can go, and so I summarize it as things are wrong from every perspective or angle. So I turn it back to you for where you want to go next with that.
Sure. So in a minute, I'll probably get to like floating versus fixed strike vol, so we can talk about that a little bit, about the price in your P&L and your returns matter more on fixed strike. But like the idea I was thinking about was, years ago, you and I used to talk about a lot of like, for a lot of long vol strategies, this slow grinding down market would be like worst case scenario pain trade. But one of the things we talked about was, mathematically, if that happened, if you kept grinding lower on a realized basis versus implied, eventually implied comes down so far that any sort of movement in realized would spike implied. But then maybe because of this vol movement or this choppiness that we're seeing on an intra-month basis, and then even on the flip side of that on an intraday basis, that's keeping vol at like this medium sustained level where you're able to have that grind down where, and like you said, we haven't had any face ripping rallies, or we've had some intradays, like, but then we did actually see the pop in vol. I'm thinking like,
the pop in vol is short-lived, right? It's very short-lived. Right. Yeah. I remember that, there's been a few days where we like vol suddenly woke up and we're like, like there's vol, and that was a bigger vol move that we expect. So vol is up and vol of vol is up, right? I'm like, okay, that's lining up, and then the next day, 3 days later, it's all gone, like nothing happened, and but the market keeps on grinding lower, right? So it not only are the signals failing, but they're failing in connection with what's happening in the market, which is the wackier part, right? And it's just like, I think what I wrote about, I know what I wrote about in my letter is this, that the information that's coming out is, there's not much shock value, right? It's like, I think what I said in the letter is, hey, breaking news, inflation, right? It's nothing, like it's not a pandemic that's going to shake up the world tomorrow. It's something that's going to pan out over the next many years. And I know there's going to be, supply chain issues. I think I've heard that for 2 years now. And we want, so it's not an event. It's not a shock. It's not something that is creating panic. It's a slow changing economy that in and of itself will only reveal how slow and changing it is with numbers that come out every 3 months, right? It's like, let's wait for the Fed. Okay, I'll see you in 3 months, right? You see what they do, and let's wait for the next housing starts or whatever it's going to be. And so we have these month-wide, 2-month-wide, 3-month-wide number outputs that are slowly and incrementally putting these boundaries on what the next few years will look like. And so the slowness of this outcome is nobody's having to dramatically reposition their portfolio. They're all expecting what's happening. All the numbers are coming out well in line or somewhat around the boundaries of what people are expecting. And so it's like, okay, let's just keep on grinding down until we see where things are. And therefore, vol is not doing anything because fear is not heightening.
And along those lines, in a way, like you were referencing earlier, is like, the VIX doesn't matter, especially spot VIX, right? It's untradeable. And the best way to look at it is like floating strike volatility is what it's representing, which means not necessarily a thing we can actually trade because we have to actually buy options at fixed strikes. And so what I love in your newsletter is you always show almost like a naive straddle versus your own P&L. So maybe talk to me a little bit about like having that fixed strike, like naive straddle, showing that like you're trading how well it's doing relative to like a naive straddle, and maybe how like naive straddles have done this year.
Yeah, I mean, it's the same answer to everything I've been saying. Is like a naive straddle is like, because vol hasn't taken off and the market's been declining, you haven't had that payoff, right? So this actually goes back to what you were saying, what we were discussing earlier, is repositioning your delta. And you were saying is if every time you're gamma scalping and repositioning, you're potentially putting on a little bit more risk to lose again, right? And you're monetizing some gain perhaps, but you're repositioning. So in doing that, you're where was I going with this? I was going to relate it back to your question. I lost my train of thought. Hold on a second.
Naive straddles and
Right. Going back to a naive, it's the repositioning is so different to a naive because a naive quote just lets it go. I'll call that delta accumulation, right? So you let it go, and so by repositioning, you're back to straddling every time, and so you're going to lower the volatility dramatically from a naive and not be subject to the pain of a naive. Now, if you're in a vol lifting environment, the naive will serve you well, but you're in an environment like this where vol is actually not doing so well relative to what's happening in the world, of course, then you're actually going to lose in a naive versus that restriking is saving you from what would otherwise be happening in the naive. And there are certain months where the naive will outperform because the market had enough vol and enough directional move for the naive to pay off. But what we've noticed is every time that happens, it so violently and quickly retracts that even though that 1 month we were off it, then by very quickly afterwards we're outperforming again, right? And over time, that divergence of us versus the naive just keeps on going, But so yes, there are certain months like you could say, oh, you should have been a naive that month. I'm like, oh yeah, that's nice that month, but over the next 3 months you're far better than it again, right? And you're already so diverged from the last 2 years that it's almost never going to catch up to you, right? So that's where that you're remonetizing and having a positive hit rate on scalping is generating profitability, and looking at it the other way where you realize that just holding a naive straddle is not a strategy that works. Long vol is too expensive to hold, especially when vol itself is not paying off, is not contributing to the gain in your portfolio. It's a bleeding trade. And unless you have some mechanism around it, you don't want to just hold straddles. That's I guess the summary I would take from all of it.
Yeah, for personal reasons, I wish you would publish a naive straddle index that I could point to versus like the VIX index. But there's so many business things you can do at one time. So kind of going full circle, we were talking about Cyborg, man plus machine, and when Kairos happens, you want to be actively trading using your gut and your intuition. A lot of it's come out recently about all these AI bots, whether it's Lambda or GPT-3. I'm just curious because you and I tend to talk about these things. What's your take on if that's if that's actual AI, or are they just or this monkey's on a typewriter syndrome and you have nothing to worry about?
So full disclosure, I don't know either of those things that those
Okay.
acronyms that you mentioned, right? So I don't heavily follow or at all follow the AI innovations and developments in the AI world. So you have me on those terms. But if I look to the general question, what do I think about AI? I think it's the same thing we've been talking about. It's empiricism versus the nonlinearity of the world, right? So we can look at the past and say, oh, based on all these things that have happened, a perfect curve fit model says that this is the forecast, and a lot of the time that works, and Google is able to, or Amazon can recommend the next song for us that we'd like to listen to, and it works in those environments. And then in dynamic nonlinear environments, it breaks down because things change in ways that have never been seen before, right? And I know there's these examples also that have happened in the AI world. I don't remember the specifics, but years ago when it was Google, I think, who was cataloging the photos, and they're doing all the photos, and there's all these stories of like there's 1,000 cats, and and then they think they've identified a cat, and then one day it's a wolf or something. I'm terribly telling the stories, but I remember some of these that at the time I'm like, oh, that's funny, where it got it totally wrong, right? There was one story I think it was the military, that a friend of mine told me that it was assessing the tanks, friendly tanks versus enemy tanks. And so they'd show the computer like pictures of U.S. tanks and pictures of let's say, foreign tanks. And so it's like, this is the friendly tank, this is an enemy tank. And then it went out into the field, and it didn't destroy or it didn't shoot potential bombs at any of the enemy tanks. And the question was, why not? And they studied this afterwards, and I guess the engineers discovered that in the pictures, the U.S. tanks were always totally high resolution, and the enemy tanks were always granular pictures, right? Or like grainy pictures, rather. Sorry. Yeah. And so on the field, everything was high resolution, so that none of them were enemies, right? And so it's like, what variable is it assessing to make its judgment, right? And that's the AI thing. So I always think of all these stories, and I'm glad I thought of one that worked for what I was trying to say. But there's so many of them, and I know the technology's gotten better. I know probably the acronyms you described are some more innovations in the modeling of intelligent modeling of things, and I know it works for chess, and I get all that. But for me, once again, when it comes to things, chaos environments like the financial markets, when things like COVID and inflationary economies happen, out of nowhere, and Russia-Ukraine wars, I don't believe that there's enough information to ever model things perfectly. And so hey, humans have to be the ones, and I certainly want to use machines, but I don't know that I could ever rely on a machine given what I've seen in the last 30 years. And I know I sound like one of these older folks that like, oh, things won't change, and oh, there'll never be an electric car, and here we are, we're all driving them, right? And so I don't mean to sound like that, but I mean to it's mind blowing to me that one can assume that such chaos and diversity of information can be calibrated in a way to be reliably forecasted with other than a human mind. And I know what you're going to argue is like, well, a human mind is just a computer, right? It's just and I'm like, yeah, that it is. But what is it that's different? And I know this is going to sound wonky, but it's the emotional side. And so the brain is the reasoning side of us, and there's the emotion that comes in, the adrenaline we were talking about earlier when we see a market crashing and I'm watching it, and I know what my brain has experienced, and I have the adrenaline of what's going on in the portfolio and the size of capital that I have potentially at risk, and all of those things coming into play. I feel like when AIs get emotion, then maybe they'll start to get closer to where we are. But I feel like emotion does positively contribute to our decision making if we have properly learned to manage those emotions, i.e., not act wildly, but say, "Oh my God, I'm feeling scared. Let me de-risk." Right. So when those emotions associate to rational outcomes and trades, then like that's something that if the robot doesn't have the emotion, how does it know to feel that to make it do that? So that's my final word on that.
No, it's great. And then, as you know, if strong AI ever does get emotions, then it'll be just as fallible as we are as well. So it's like,
exactly.
It's the
so there's
force.
No way. I love that. Thank you. What a great counter to that, or answer response. Thank you. Yeah, exactly. That's nice.
And then let me timestamp this real quick because we most likely will cut this, but it was on my mind today, so I wanted to bring it up with you. Is our mutual friend Corey Hofstein? Him and I were talking about cybersecurity today because
Sure.
A lot of times. At our firm, that's one of our primary focuses on cybersecurity, and it's interesting how much our industry has changed a lot. Is like there's the business of trading, which is semi-manageable, and then there's the business of running an investment managing business, right? And Corey tweeted out today, and then we talked about it later, is whether somebody used social engineering or whatever, they were able to hack his phone, disable his 2FA or change his 2FA, and that way they were able to get into his emails and his phone and et cetera. Luckily, he was able to catch it fairly quickly. But I know you and I have talked about before that you had an attempt as a man-in-the-middle attack. And so, like, about a wire transfer. And one of the people that reached out to Corey was a co-founder of a hedge fund we all know very well that now is able to run a family office. And he was saying, similarly to Corey, he reached out because he's like, this is actually what concerns me more than about any of the trading or investing is actually the protection mechanisms for our wires. And so what things like they do are like anything from whether you're using internal signal chats to using Zoom when you're talking to somebody about a wire transfer, to also try to make sure it's the same person you have a relationship with. But how is it the first time with that relationship? I'm just curious because I know what you've kind of been through is like, how do you think about, like, these are the things that these are the true existential crisis to running an investment management company, is if you got hit for a $10 or $20 million wire that went to the wrong place, that can destroy your entire firm, no matter how well you've traded for decades on end.
Yeah, that's such a good point you make, is that we're all talking about trading risk, and at the end of the day, the absolute height of it is operational risk, right? We know that very well. We're so focused on operational risk. In fact, we've had, my company's, my firm has had more hires on the operational side than we've had on the trading and quant side, right? Our quant team has been the same team, and once we started growing, and it was all about operational risk and operation, and that's really what's grown the most in the last few years, is that side of us. And exactly to that point, it's 2FA and it's BitLocker and it's and ransomware protection and virus shields and go down the list. And we have this whole cybersecurity plan and different providers we use and so like at the end of the day, it's funny as I was discussing this exact issue with someone recently, and I'm like, so much of it comes down to common sense, right? So you're right. We got an attempted attack, and we have all this cybersecurity, and yet somebody did this. I'm not going to explain the trick on live because I don't want it repeated, but it was something that came to us, and it's noticing something. It's being hyper aware that knowing that there are so many people out there in the world trying to intercept. And so something looked weird, and when it looks weird or you feel anything, just holding back and saying, you know what, I'm not even going to trust my 2FA right now. I'm just going to pause and figure out if this is real. And we just got an email 2 days ago from something that looked like the SEC, and there would have been no reason for this to come. And right away, I'm like, I don't trust it. Don't click that link. And it made it through our spam and our phishing filters and all the stuff that we have, which is really well set up. And we're like, and so then we contacted a consulting firm and say, have you ever seen the SEC come from this address? And they're like, oh yeah, SEC sends that all the time. That they're just, they're looking for an answer to a question, and it was minor. They needed one of our people's, right? It's whatever it was. It was not silly. It was just pure information, and they were just asking us, and they do it very securely. So but it was benign. That's the word I was looking for. But the point I'm making is, as soon as I saw it, and like the SEC, I realized to myself, that's the word that people that bad people in the bad side of our industry would use to try to get to us, because they know how much we're going to be attentive to an SEC email, and so that's the first thing we're going to click, because like that, that's what you're, during the daytime, that's what your adrenaline is going to. Oh my gosh, I better click that. And so being hyper aware of it, to me, it got through enough filters. Therefore, you have to use, once again, going back to AI versus the human, it's the human who has to protect themselves. That's what I say. And it's not, you can't trust the AI of the phishing and spam filters. You have to trust yourself. And anything I ever see now that I don't fully know the person or trust, or be on that direct call getting the wire instructions in person, I'm not going to send money or move money or allow it to go anywhere. And that's on topping having two people who sign for money to move from our account and all the stuff that we have. That's all just what everybody has. At the end of the day, it's not trusting the AI, but trusting your own vigilance, I guess, is what I'll say.
Yeah, it's shocking how advanced these like phishing attacks have been, and like when you look at the email and everything, it looks like completely legit and everything. So my default at this point is I don't click on or reply to anything. So hopefully, if it's our overlords, so to speak, they're at least empathetic. There, maybe we might miss a few of them because we're afraid of clicking on any sort of link that could potentially be nefarious. With that said, Wayne, I always enjoy our conversations, and I appreciate you being able to come on the podcast, and I look forward to our future conversations as well.
Yeah, thank you very much for having me. I enjoyed it very much. These conversations go in a long and windy path, and I love it. Good talking to you, Jason, as always.
Thanks.
Thanks for listening. If you enjoyed today's show, we'd appreciate if you would share this show with friends and leave us a review on iTunes, as it helps more listeners find the show and join our amazing community. To those of you who already shared or left a review, thank you very sincerely. It does mean a lot to us. If you'd like more information about Mutiny Fund, you can go to mutinyfund.com. For any thoughts on how we can improve the show or questions about anything we've talked about here on the podcast today, drop us a message via email. I'm Taylor@mutinyfund.com, and Jason is Jason@mutinyfund.com, or you can reach us on Twitter. I'm at Taylor Pearson ME, and Jason is at Jason Mutiny. To hear about new episodes or get our monthly newsletter with reading recommendations, sign up at mutinyfund.com/newsletter.
This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Mutiny Fund, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed to not make specific trade recommendations nor reference past or potential profits. Listeners are reminded that managed futures, commodity trading, forex trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they're not suitable for all investors, and you should not rely on any of the information as a substitute for the exercise of your own skill and judgment in making a decision on the appropriateness of such investments. Visit mutinyfund.com/disclaimer for more information.